Talking about liquidity concept, like I told you, liquidity concept for me it's my edge over the market. The moment you tend to understand liquidity concepts, then you stop being liquidity to the market. So now, what does liquidity mean? On a simpler term, liquidity simply means money, right? That's just what it means. So, like I told you from the onset, we've been defining terms like in school. We'll just be doing like those practical work, right? We'll be doing more of practicals. So now we have two types of liquidity. We have internal liquidity and external liquidity. What does this external liquidity mean? External liquidity are liquidity that are found on swings, right? You know, on our last session, I was talking about swing, but I told you swings simply mean extreme, right? On the market, simply mean extreme. So now, external liquidity are liquidity that are found on swings. Let's take, for instance, this right here. This is an external.
Okay.
So I want to ask you a question. If we call this particular zone our high, right? We are talking about swings now. Like I'm trying to reiterate what we did on our previous session on swings, market swings. If this is our high, this is our low, lower high. What do we call this zone?
That's a lower high.
Your response indicates clearly you understand what swings are. So now, with that understanding of swings, brings us to external liquidity. All these zones that I've marked out, that you have actually responded to, all these are what we call external liquidity. Right? All these are what we call external liquidity, ranging from the higher high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, higher high, higher low. And all these are what we call external liquidity. And what you want to ask, okay, what is now the importance of external liquidity? So I want you to get your writing material and then put this down. External liquidity there are zones where you put your take profits and all your stop losses. Those are your target zone, right? Like I always used to say, the market always chase liquidity. So now, external liquidity are your target zone. Let's take, for instance, we enter long from this particular region. Our stop loss will be below the external liquidity, like below the low of the external liquidity, and our take profit will be at the edge of the higher high of the external liquidity. If you want to take any trade and you are getting confused on where to put as your TP, I've had this kind of question over time, and whereby some of the people, they ask me, oh, how do I know where to put my TP? If you want to put your take profit, your target, you target external liquidities as your take profit, and then your stop loss should be below the external liquidity. So you can see these are external liquidity. Like I said, markets always like to chase liquidity. So now, why are we putting our stop loss below this liquidity right here? So if market want to do crazy thing, the worst it can do is what? Take out the liquidity. That's the worst market can do. So that's why it is always advisable to put your stop losses below external liquidities and your take profit at external liquidity. Is that clear?
Yeah, sure.
Good. So now let's come to internal liquidity. This is now how you avoid being liquidity to the market. Internal liquidity, there are liquidity that lies in between market structures. There are liquidity that can be found in between structures. And what are those structures I'm talking about? This type of liquidity lies on fair value gaps. They lies on double tops, double bottom. I hope you know what double tops mean. Okay, like I said, I assume you don't know, but then double top simply mean, if you go to your Chrome now, just type in double top or double bottom. The outcome of every double top is bearish, just like this. Outcome of every double top is bearish. And this is what we call double top. And the outcome of every double top is what? Bearish. And this is double bottom. The outcome of every double bottom is what? Bullish. So now let's talk about internal liquidity. Like I said, internal liquidity, the liquidity that are found within structures. right? So now let's use these examples we have been using, these chart patterns we have been using previously. So now internal liquidity can also be called fair value gap or imbalances, right? Let me give you an example. The moment you are looking at your chart and then you are trying to identify internal liquidity, but then you can't find any internal liquidity on the chart. But if possibly there is an imbalance or a fair value gap, you should take that as an internal liquidity, because yes, that is also an internal liquidity, right? So fair value gap is an internal liquidity. That's something you need to note. Let's look for internal liquidity I'm talking about. So on this particular scenario, if we are looking at internal liquidity in this particular chart, you can see this is an external liquidity, internal rather. This is also an internal liquidity. This is also an internal liquidity, right? So these are internal liquidity. Those liquidity you can find close, very close to your order blocks, very close to your point of interest. Those are what we call internal liquidity. So now let's go back and look for a better example. Let's take this as our POI, which is our point of interest.
So it's similar to order block, but is there a difference between it and order block?
Okay, let me tell you the difference between POI and order block. You know, order block are everywhere in the chart. Everywhere in the chart. Whenever there is a break of structure, there's an order block right there, right? But
Okay.
is that order block valid? No. Every other block you see on the chart, not all are valid. Right? You can see another block that the market might not respect. Right? The market will just sweep it out like it's nothing. Right? But the moment you call another block a point of interest, like the moment you call it a POI, meaning you are having like an intention of taking your trade from that particular region, from that particular order block. So once you see another block and it is called another block, of course, I can even tag one place as another block and then still make that place as my POI, right? But the moment I use the word POI, meaning that's where I'm interested in, like the name implies, point of interest. That's what that particular zone is what I'm interested in. I hope that's clear.
Sure. Okay.
Okay, good. So now on this particular order block or POI, right, we have a fair value gap right here. Let's say imbalance. So where is our internal liquidity in this case? One, these two, these three, and these five. Right? In as much as that particular candlestick does not tap into your POI, it's a liquidity. Until all the liquidities are being swept, that particular POI remains valid. Right? So internal liquidity is what validates another block for it to be called a POI. This imbalance can also be an internal liquidity, like I said, right? Because it is the creation of this particular imbalance was caused by impulsive movement. But in as much as there is a gap to be filled, it's a liquidity. Right? So even though you don't have all these internal liquidities right here, in as much as you have an imbalance, you can take that as your internal liquidity. Is that clear?
Yeah.
Good. So these are what we call internal liquidity. But then this is how to correctly mark out your internal liquidity. You must not circle them just like I did. I'm just trying to pinpoint them to illustrate them for better illustration. So for me, I do them like this. I just draw a line and I can just say like this. This is my liquidity. Do you understand?
Yeah.
So let's look at this other scenario, right? Let's look at this scenario and then let's assume there is no fair value gap. Although we have a fair value gap right here, right? But then let's assume there's no fair value gap. So I will take this zone as my internal liquidity. Right? So now let's take, for instance, we have a chart pattern like this. Mark out our structure. We have a break of structure right here. So let's assume we have a fair value gap or imbalance. Right? So now, on this particular scenario, let's take, for instance, you see something like this on the chart. So what you have to do is this. Once you see this particular chart pattern, right, you have a downtrend or an uptrend, you have two break of structure in a particular trend, and then you have this particular pullback. So now, this is what you do. You see, this you have this break of structure, and then this is a pullback. You know, I taught you what a pullback is, or retracement, right?
Yeah.
So now, this is a pullback. And if you notice, this particular pullback failed to tap into this other block, right? It failed to tap into this other block, and then it failed also to fill this fair value gap. You know, like I told you, I said fair value gap are gaps that attract liquidity, that attract price, right? So now, this has failed to attract this price right here. So that means that this particular zone is still very, very valid, right?
Okay.
Let's take, for instance, we have something like this. Let's say we have something like this. You can see it has not still tapped into our other block, but it has filled our fair value gap. This zone is like 50-50 probability. Although we still have an order block, right? You know, from your own definition of what order blocks is, like the name implies, where orders has been set up, like where limit orders have been placed. So limit orders have been placed right here. But then I told you imbalances are what attract price. So now these imbalances, this particular fair value gap attracted price to it, and it has filled it completely. But it has failed to tap into our order block. This particular order block is now like 50-50 probability for it to hold. Right? Because most orders has been executed, because there are some traders that actually would execute their trade from fair value gaps. As failed to fill this fair value gap and failed to tap into this other block, this particular region is still very, very valid. So what do you expect as a trader? For me, I expect something like this. Of course, this is another block, so there are orders here. Right? I expect price to react from here a little bit and what tap into this particular OB and then sell down. This is one chart pattern you should put into consideration. If possible, you can take a screenshot of this particular chart, so that if you go into the market, you can say, okay, this is the kind of pattern I'm looking out for. Once you see this kind of pattern, just take your trade. Although it is not 100% accurate, but then at least win rate of about 70% is guaranteed. So now, let me give you another example of this same scenario on an uptrend. I always target 1:3. I advise to take a screenshot of this particular setup.
So the main thing is to wait for that inducement.
Yes. Like I always say, once you don't see inducement in the chart, you are the inducement. Same as once you don't see a liquidity in the chart, you are the liquidity. So now let's take, for instance, those traders that will take their trade from here. You know, there's another block right here. They will take their trade from here. And why do they take their trade from here? There is no inducement for them to like identify. No, do you see any liquidity right here? There's no liquidity right here. So they will just come and then place their sell limit here, and then expect price to just work out for them, right? But then me, on the other hand, who is a liquidity trader, have identified their zone. This zone where they put as their POI, I identified it as an inducement for me, right? So I will wait for price to take out the inducement and then come into my other block at the extreme. Unlike other traders who don't actually know what liquidity concept is, they'll just come here and take their trade from here. For me, with bigger knowledge, I know that, okay, this place can serve as a liquidity zone. Do you understand?
Yeah, sure.
So
like that means you must wait for it to form first.
Yes, you just have to wait for it to form. And most of the times, it already forms in the market. You can just go to a random chart and just see that, okay, this particular thing has already formed in the market. It's very, very possible.